If you've been sidelined in the housing market thinking everything is just too expensive, 2026 might actually have some good news for you.
Oh, really? Because last I checked, prices were still looking pretty scary.
They are, but the government is updating the rules. The FHA, that's the Federal Housing Administration, is raising their loan limits significantly starting January 1st.
Okay, so that means they'll insure bigger mortgages? How big are we talking?
Get this, in high-cost markets like New York, San Francisco, or DC, the FHA will now back loans up to nearly $1.25 million.
Wait, hold on. You can get an FHA loan, which is usually for first-time buyers, for over $1 million?
Exactly. Specifically, $1,249,125. And remember, FHA loans let you put down as little as 3.5%.
That is wild. 3.5% down on $1 million home? That changes the math for a lot of people.
But what if I don't live in a fancy metro area? What about the rest of us?
They bumped up the floor, too. In lower-cost markets, the limit is rising to about $541,000. That's up about $17,000 from last year.
Okay, so even in affordable areas, you've got $500,000 of wiggle room. That covers a lot of ground.
It really does. It prevents the FHA from insuring luxury mansions in cheap areas, but keeps the door open for normal folks.
Is there anywhere higher than that 1.25 million mark? Or is that the absolute ceiling?
Actually, there is. If you're house hunting in Alaska or Hawaii, the ceiling is over $1.87 million.
Nearly 2 million? Why?
Construction costs. It's just way more expensive to build out there, so the loan limits have to match the reality of the market.
So how do they come up with these numbers? Is it just random?
No, it's all tied to the conforming loan limits set by Fannie Mae and Freddie Mac. Basically, as home prices go up nationally, the limits go up.
Right, so the FHA is just keeping pace with the rest of the market.
Exactly. The FHA limit is usually calculated at 115% of the median home price in a specific county. The big takeaway here is access. More than 80% of FHA loans go to first-time buyers.
It makes sense. If you don't have a massive pile of cash for a 20% down payment, FHA is often the only way in.
Right. These increased limits mean first-time buyers aren't locked out just because they live in an expensive city.
But there's a flip side to this, isn't there?
I was reading that delinquency rates on FHA loans are creeping up.
Yeah, that is the elephant in the room. Recent data shows nearly 12% of FHA borrowers were behind on payments.
Yikes. Compare that to regular loans?
Regular loans backed by Fannie and Freddie are under 2%. So FHA borrowers are statistically struggling a lot more right now.
It comes down to equity. When you only put 3.5% down, you don't have much of a cushion.
Right. If home prices dip even a little bit, you're suddenly underwater, owing more than the house is worth.
Exactly. And that makes foreclosure a much bigger risk if the economy takes a turn.
So while the high limits are great for buying power, they definitely come with higher risk.
So who should actually use these FHA loans?
Well, if you have a credit score over 700, the experts say you might want to look elsewhere.
Yeah, you'd probably get a better deal with a conventional loan and private mortgage insurance.
But if your score is lower or your down payment is tiny, FHA is still the king. Recent premium cuts have made it even more attractive.
Bottom line, 2026 gives you more purchasing power, but make sure you can actually afford those monthly payments.
Just because the bank says you can borrow 1.2 million doesn't mean you should.
Wise words. Check your local limits because they vary by county. And happy house hunting.
Catch you next time, guys.